So just a little plug, if I could. I spend a lot of time working with an organization. So while we're talking about veterans, I am the board president for an organization called Hooves. And what we do is we use rescue horses to rescue veterans. We put veterans or active duty military that are suffering from any type of PTSD challenges through a 4-day retreat. After the 4-day retreat, they indicate about an 80% decrease in suicidal thoughts. Last year, we were able to help 70 veterans go through our program. We'll be starting that process. We have our first retreat is next month. If you are a veteran and or you have a child who maybe has some challenges or anybody who is a veteran, please let me know. I'd be happy to tell you about some of the things that we have coming up at Hooves. Also look for some tours that we'll be coming up around the farm. And it's really great that we're able to start to get some national news on what we're doing. We recently did an episode with One American Network, and I know a couple of people came up because they saw our episode on One American Network, but it was able to feature Hooves here locally in town. So I just want to throw that out there for all of my veteran families that we're always here for you too. Inflation, I'll hit on inflation. Inflation is now at roughly 7.5%. The takeaway of the opportunity for inflation is if you haven't looked at it yet, pay attention to government I-bonds. Remember the good old bonds you got when you were a kid and grandkid from grandma and grandpa and you haven't got one in a long time? Government I-bonds are currently paying 7.12% interest. Government I-bonds are currently paying 7.12% interest backed by the full faith and pledge of the United States government without any market risk. If you haven't looked at government I-bonds, you can go to the Treasury Direct, and it has all their information and all the details, so you can read the fine print on their website. Or please see me, Jeremy, or Scott, or any one of the other retirement guys, and we'd be happy to go over that. That is a perfect example of a great opportunity that most people aren't taking advantage of right now with inflation. With rising interest rates, what history would tell us about rising interest rates is the market typically can absorb rising interest rates, and it usually shows, as the chart shows, that again, over the course of time, over 2 years, rising interest rates has not historically had a big impact over a 2-year time frame on equity prices. What this chart would show is that if the Federal Reserve aggressively raises interest rates quickly, the markets tend to perform more poor. So that's been one of the debates that's been going on for the last couple of weeks, is the markets are trying to figure out what is the Federal Reserve going to do. The overall anticipation plan is they're probably going to raise interest rates 3 to 4 times this year and a total of maybe 7 times over the next 2 years. But again, things can change in a hurry in the economy, and the Federal Reserve will figure that out. But this slide would show that, again, the tightening of interest rates with the Federal Reserve going back to 1946 over a 2-year time frame doesn't necessarily mean a big impact for equities. Short term might have a bigger impact if they raise rates aggressively. So here's the sectors and what the performance has been after the first rate hikes. So what you can see is on the left-hand side, some of the best performing asset classes, and then on the right-hand side, some of the worst performing asset classes. So the top of the list is energy, what we just talked about. Second on the list is technology. Third is financials. Fourth is healthcare. Fifth is communication services. So there are still some strong areas, and these are, again, things that we're taking a look at as we look to fine-tune the asset allocation with the portfolios and what we own. Is these are the sectors that tend to perform and what their performance has been after the first rate hikes. So what should long-term investors do? Do the things that we've talked about so far up to this point, which is avoid the short-term noise of the market, avoid panicking, stick to your plan, and when everybody else is panicking, that's the time to call Nolan, Scott, Chaz, Jeremy, and look for the opportunities, because we'll be looking for them too, but It's always a two-way street. We love hearing from you guys too. If you want to look at opportunities, please call us. And then also please call us as well. You know, what Swan said about sleep well at night, that's what we want you to do, is to sleep well at night. So when you're not feeling comfortable, that's when you should reach out to us too. Let's have a conversation. We can adjust things correctly, but we want to try to be proactively. And as fiduciaries, we're going to try to tell you what we think is in your best interest. And obviously, at the end of the day, it's your money. You can make a decision on what you want to do there, but we can kind of help guide you down the right path. And my 28 years of experience has said time and time and time again, having a conversation helps out a lot when you're not feeling good about what's going on. And we can pull out a lot of the data and talk about the things that we want to do. Before I wrap up my presentation, I did want to invite Joshua to come up here. Josh and I have been good friends for quite a long time. I've been working with First Trust, I think, for probably 20 or 25 years. Again, many of you also have First Trust within your portfolios. What First Trust does is a lot of what is referred to as defined investment strategies. You know, I think one of the best things that I got from my service in the military is it taught me to be disciplined, and that discipline really helps when it comes to being successful in the stock market. So naturally, what I loved about them is their disciplined investment approach when it comes to investing. So I'd maybe start with asking you a couple of different questions that I was thinking about on the things that we were talking about. So we just finished talking about inflation, but actually, inflation's been something that you and I have been talking about for quite some time. So why was it, or what was the process that First Trust went through that was really able to try to identify some of the issues with inflation before it became headline news?
That's right. Yeah, we were, for those of you that follow the news carefully, wow, for the last year and a half, our political bettors have been telling us that inflation was transitory. It was not here to stay. And then something happened where all of a sudden now they've changed tunes. And about a year and a half ago, our chief economist of First Trust Portfolios, we said inflation is anything but transitory. It's going to be stubborn. It's going to be here to stay. And simply put, one of the reasons we said that, and I thought a long time about how to help you all in a very simple way understand what we saw that was going to keep inflation in place. And I'd invite you to think about it's kind of a silly object lesson, but it's very simple. Imagine that we had an economy with 10 apples and $10. You have $10 chasing 10 apples. How much is each of those apples costing? This ain't a trick question. This is not high math. $1, right? But imagine in our little fictitious economy, let's say we printed $3 new. And now all of a sudden we have $13 chasing those same 10 apples. Well, now how much is each apple? This is the interactive portion of the evening, right? $13 or $1.30, right? It goes up because there's more money chasing those apples. Well, now let's take that one step further and let's imagine that something happened to interrupt the supply of those apples, and now all of a sudden our 10 apples becomes 5. Well, now we're at $2.60 an apple. You see, inflation isn't that hard to understand. The government was printing money. There's a measure called the M2 money supply that usually grows at about 7% a year, and they grew it during COVID at 37%. So that is a lot of new money out there that wasn't out before. And in the process of the shutdown, they created some supply chain disruptions. And so you put those two things together, it wasn't one bit of a surprise to us why inflation is here and why it's likely to stay for a little while.
Awesome. So I was asking Scott a minute ago about the current, political environment that we have, and also about like what's happening with Russia. What would First Trust take be on the current environment within the markets in Russia?
Yeah, so when it comes to Russia, the reality is the chief investment officer of our company has a wonderful saying. He said, statistically speaking, the end of the world doesn't happen very often. All right? The reality is what's going to happen with Russia as it applies to the markets? The truth is it's unknowable. None of us know for sure. The only thing we can do is make our best guess about what's happened in history. And Nolan mentioned, he kind of alluded to it, that in all of the military conflicts that have broken out since the 20th century, with the exception of World War II, 1 year after they broke out, the markets were positive. So that's all we know for sure. Is there a possibility this time it's different? There is. But we would argue that usually you go with the averages and say that from where we are here, statistically speaking, the end of the world doesn't happen very much, and statistically speaking, a year from now, the markets will likely be higher. We don't know that for sure, but you just kind of got to go with what history's taught you and kind of head that way.
So I talked a little bit about inflation, and I just shared an idea about government I-bonds.
Yeah.
But if I take inflation, look at it a little bit bigger, again, ask the question, what's First Trust's opinion of investing in an inflationary environment?
Well, and thank you you gave me a solid when you were talking about capital strength. So Nolan was talking about our capital strength process at First Trust, the idea that you have companies with strong balance sheets. Our view and what history has shown us is that a different type of investments work better when inflation's higher. And I want you to think about this for a second. In the last 10 years or so, rates have been really low. It's been very easy to borrow. It's been very easy to get capital. So what kind of companies do well when it's very easy to borrow and when it's very easy to get capital? Growth companies, speculative companies, in many cases companies that are not yet profitable but have bright futures. And that's why you see a lot of these non-profitable technology companies that over the last 10 years have just done an amazing job running up in price. But if you look back in history, when rates start to go up, which usually, as Nolan said, accompanies inflation, the cost of borrowing gets tighter, and investors begin to prefer companies that don't necessarily need to borrow money in order to fund their operations. And so what better way with capital strength, is companies that have a lot of cash, they have low debt, they have high profits. Those are companies that aren't likely to have to go out and find new capital when rates go up. And so that's the way we think of as companies with those strong balance sheets, those will do well. One of the things I was telling Nolan, he didn't even know this, I had never told him this before, but I've been with our company 22 years, and the capital strength process was actually born in October of '08, which was another time we were all feeling pretty low, right? It was well into the financial crisis, and that same chief investment officer that I told you that says, statistically speaking, the end of the world doesn't happen very much, he got on one of our calls and he said, folks, what we're going through right now is one of two things. It's either the end of the world or the best buying opportunity we're ever going to see in our careers. And he said, I don't know what companies are going to make it out of here, but we're developing this strategy called the capital strength, and I'm pretty sure these are. And if you roll forward the next several years, boy, was he right. And it gave a lot of investors the confidence to kind of jump into the market when they were feeling kind of scared. And frankly, I'd been in the industry 10 years at that point. I was feeling kind of scared. But it gave me the confidence to push some money to the table, too.
Awesome. So I know I've gone a little bit over on my speaking time, but I think it's so valuable in the things that you're talking about. Maybe any final thoughts?
Yeah, so I do want to brag on Nolan. He's way too humble to say this himself. But my job is to work with financial advisors. I advise financial advisors. I talk to a lot of them. And over the years, I've seen a lot of advisors decide to put defense into their portfolios after the market has pulled back quite a bit. And in February of 2020, you guys remember that, we really at that point, we had all heard of COVID, but we didn't really know for sure how bad it was going to be. But the markets were at highs, and Nolan and I had a conversation, and he had the courage to put a considerable amount of money in one of our hedged equity portfolios around February 18th of 2020. And I can tell you from experience, and we're working with over 2,500 advisors, there weren't but a handful that put the defense on before the market tumbled. Many have since put it on after. So I credit Nolan to that.
I appreciate that. And I know that I think you were here in that February 2020 Economic Summit. That was the last event that we had that we could all kind of get together. And if you remember me talking about the fact that the markets were very elevated, the risk was high, that's when we wanted to hedge. You're correct. You don't wait until things go bad and then try to make changes because it's already too late. Call it luck or skill, but it absolutely worked out, and I appreciate our relationship together. They'll be available. Again, he'll be here. A couple of things just as housekeeping items. If you want to connect with me or any one of our presenters tonight, all you got to do is just scan this QR code. If you aren't good with scanning QR codes, Travis in the back is our resident expert on QR codes. He can help you out. Any one of the girls can help you out. So we can make sure that you connect with us anytime tonight if you want, whether it's here tonight or if you want to schedule a time to get together with us. And again, I would also say if you take a minute, if you love what we're sharing tonight, I ask you as a personal favor, if you could click on that link to give us a review. Just tell about your experience of working with our firm. And if you do so, make sure you grab another ticket for our raffle. So with that, my time is up, and I appreciate everybody giving me an opportunity to kind of kick off tonight's meeting. But I know we have a lot more presenters as well, and so I want to go ahead and turn over our presentation to Certified Financial Planner Chas Price.